feel free, guys. You can come in tight, sit wherever you'd like. We're just kind of doing introductions and stuff. So I'll just give a background on myself. So I grew up in Northern California in the Bay Area, and then I went to school for computer science, and then I also did kind of like a career pivot where I got the real estate bug in school. So even though I was studying computer science, I started to get super interested in real estate, which my family previously, where it was in residential brokerage. So I had kind of somewhat of experience in the residential side, but I wanted to get into commercial side, more like investments, more institutional type stuff. And so that led me to, instead of single family, getting into multifamily. And then kind of with my no experience and kind of like not knowing how hard it all is, just with my naiveness, I just jumped in and kind of fast forwarding a bit, met my business partner, and we just put a $15 million deal under contract, had no idea what we were doing. And we went out and raised the money, raised the debt, made mistakes on everything, management and all that. And so kind of just learned on the job and really made every mistake. And so that what happened in 2018. And then fast forward to today, we have a portfolio of 700 million assets in Texas that we manage in-house with about 150 employees. We've got about 10-ish people here in New York, some virtual assistants in the Philippines, and then the bulk of the employees are in Texas, obviously doing the day-to-day management, construction, et cetera. So that's kind of just the super fast recap. Some more kind of unique things about us and kind of about the industry as a whole is we kind of, because after I say that intro, the first people say is like, well, how did you do that, right? And they say, where did you find the money? And after I tell them there, it's like, how did you get people to trust you, right? So those are kind of all like the typical line of questioning, and it's kind of perhaps the more interesting part of the story, right? And so I don't want to necessarily make the conversation all about that because there's so much to talk about. We're talking about different projects or where the market's at today, or how teams are structured in the business, and innovations like that. But just to answer those questions, because I do think it's an interesting part of the story, basically the first deal, like I said, we put it under contract. It was $15.4 million. We had to go raise $4.5 million. And so I started by asking my parents, and they invested the earnest money deposit of $300,000, and that got the deal under contract. And so now I was risking money that wasn't even mine and just going to raise money. And so my business partner, fortunately, was an attorney in New York for 12 years, so he had kind of a bigger network. So we ran through his network, asking everyone for money. And so basically, just to kind of just share the story, there was no magic sauce. It was just a ton of asking, ton of rejection, and just meetings, being super humble and willing to give up pieces of the pie to get the deal done. And I just remember thinking to myself and telling myself, it doesn't matter how I get this deal done. If I make no money, if I have to give all the equity away, it's worth it to close the first deal, right? And so I think that's a good mentality to have, obviously, when you're kind of starting out and understanding, like kind of taking a humble approach of understanding, like, okay, this is where I'm at today, but this is the bigger picture, right? And so that led from, getting the first deal done. Now all of a sudden you got the first deal done, and you get a little more credibility and more relationships. Then the brokers are taking you seriously. You're getting more deal flow. And so, kind of cliche, but obviously the 0 to 1 and getting the first thing done, whatever it is obviously the hardest. And then we kept going and going and going. And one of the big things for me that I felt early on was, gosh, I don't like dealing with a bunch of investors. Like, I wish I had one big institutional partner like PGIM or Raymond James, and they just give me the whole check and I can go about my business, right? And so I got really into that and went to conferences and try to meet all these big firms and try to figure out what's their criteria, how can I get their funding. And it's a crazy story for probably another time, but we got a small private equity firm actually to fund our second deal. So that was pretty unique because most people don't get that sort of level of investor on their second deal. Right? Typically, like, hey, you do a couple deals, you have an exit, you prove yourself, and then an investor like that or a fund will bet on you, right? So, but we got that experience, and it actually was a pretty pleasant one, which if you hear from other people, they can talk about how institutional capital is like a double-edged sword, and they kind of like control your life and ruin you and like rip your face off with fees and terms and stuff. So I didn't have a bad experience necessarily on that deal yet, but over time we partnered with some family offices and did some bigger checks, and I kind of got a little whiplash from wanting it so badly to then getting some of it and being like, actually, I don't know. So it's been this waxing and waning over the last 7 years of like wanting to get big checks, wanting small checks, and back and forth. So anyway, the unique thing about us and our vision is we want to kind of look and operate like an institutional operator and yet be funded through the syndication model, which has proliferated over the last 10 plus years since 2012 with the Jobs Act, which really legalized and formalized these SEC compliant fundraisers, and then obviously with internet, technology, social media, and with just the automation associated with being able to literally have like 400 investors in one deal, it's made this business model viable, and we want to really drive that. Like a lot of people, they start with the country club money, and then they want to graduate to the big checks, and I think that's super valid, but it's a slightly different business model. So we've honed in on this idea, and I can share more about that if that's interesting, but that's kind of our guiding vision at the moment is, we want to scale to $2 billion AUM in a couple years or so, and have it be pretty much all with retail equity, with the biggest check being $5 million. So yeah, that's kind of where I'm at and what's exciting for us right now. So you guys came in a little bit. Everyone else had the chance to kind of share their background. So if you want to share what you're up to and stuff, that's cool, and then that can help steer the conversation. And feel free, we can ask questions or whatever.
Yeah, absolutely. So before I started my master's here, I actually worked on the construction side of the business, worked for a mid-sized general contractor in cost estimating. I learned a lot about pre-construction, hard cost estimating, and whatnot. And now that I'm here, looking to pivot more to the equity side of the business, working for a developer. Currently interning for a small private equity firm out of Midtown called Australian Investors on their acquisitions team. So looking at acquisitions across multifamily, industrial, retail, office, all over the country. So yeah, that's a little bit about myself.
Nice.
Family business in real estate. I worked in finance at KPMG and Dow Jones. Looking to pivot towards industrial, go for my own. That's what I came.
And what does the family do?
They operate in 4 states in India. We mostly do acquisitions. We've done some ground-up projects. Looking to move away from that side of the industry.
Office or multi?
Single family, and we do have hospitality projects.
Okay, cool.
Background is an architect. The product design, so I've been working for like 10 years in medical design side of things. Worked 10 years in the UK as a product designer after my first master's. I'm doing masters to try to continue into the developer side. For the past 4 years, I was on the asset side of things, like being the technical advisor on the things we were designing, developing. And I think that's where I want to be more into the development and things happen.
Okay, cool.
Background, who we are?
Yeah.
So I just walked in. Tom Duffy from Texas, worked in the entertainment industry for 4 or 5 years in LA. Graduated from SC undergrad, I studied business with film. In 2020, I pivoted into single-family homes in Dallas, Texas, on the development and construction side. Want to be a little further away from the asset in the form of real estate private equity. So here I am on the program and looking at something here.
Nice. Okay, cool. All right, one more, and then if more people show up, we're gonna move on. It started.
Just a background?
Yeah.
Okay. I graduated from USC for business and real estate finance in May, and then came straight to this program. So I don't have much experience. I interned for a real estate private equity company my junior year summer, and then right now I also intern for a family office, both doing multifamily workforce housing.
Wonderful. Okay, cool. All right, so for those of you that have been here, I'll give you guys a little preference. So you guys have shared some backgrounds, so you guys know kind of what each other are up to, and I shared mine. So anyone want to kick us off with like a particular topic that we want to all discuss, or a question? Anyone want to jump in?
Yeah, that's fine. In my talks with networking talks, one point that I found interesting that was mentioned to me in terms of this is from like more of a senior guy kind of asking for advice how to navigate the real estate industry. He mentioned that you should figure out if you're an entrepreneur, or if you're entrepreneurial. So I was wondering, you kind of had that path where you're, raising money and kind of taking the entrepreneur route at a young, relatively young age.
Yep.
So I was wondering if you could kind of speak about that a little bit more and kind of how you, I don't know if navigating that path is the right word, or just kind of what went into that and some challenges. You mentioned some, but just in general, that kind of whole process of raising money and kind of being an entrepreneur in a sense, to raise money and develop.
Yeah, so I think the big distinction between what you're saying, which is entrepreneur or entrepreneurial, right? Noun versus adjective, is in our business, the big distinction is risk and raising money, right? Because you can be kind of like running the show at a family office or at a small private equity firm, and like if you network or you find the right home, not saying this is what you want to do, but if one of you guys wanted to, pretty fast you could find yourself at a small company and rise up, and you could be in a situation where you're doing a lot and you have a lot of responsibility, right? So you're directing, you're looking at deals, you're analyzing, you're making investment decisions, or at least a party to that investment decision, and then kind of driving the bus on things. But at the end of the day, you probably aren't taking any risk from your own money perspective, or perhaps even from your own reputation perspective. So that's a huge difference between entrepreneur and entrepreneurial, right? And then the third category, which would be not entrepreneurial and not an entrepreneur, right? And you're kind of just like, not to be derisive at anyone or anything in particular, but you're at a massive company and you're kind of just like plugged in, and you're like, okay, I work at Blackstone and all I look at is this asset class on this day of the week and like in this area, right? And you don't really have, and then you've got this ladder to climb and stuff like that. So I think I don't have experience with that, so I'm only kind of just looking at it from afar. But to me, that feels and seems a lot less entrepreneurial than the other things we discussed, like smaller company or even going out on your own and taking the true risk associated with capital and reputation. And then the other piece is raising money, right? Like if you're, like going back to my example, running the show at a smaller company, or we're a small company, and I don't want to get too like down this rabbit hole, but we had a guy who came out of college, so he was basically, let's say, 22 years old, and he started as an acquisitions analyst, and then unfortunately, it's maybe like a year or so, maybe a year into his tenure, we had to let the director of acquisitions go. And this was like an opportunity where I pick up the phone and it's like, all right, like here's your shot, you can step up. Like it's no guarantee that you're gonna like automatically get this promotion and like life's great, but like you have the opportunity. And he took it and ran with it, and he's done a fantastic job. And so now he's, I don't know, 24 or 25, and he's doing better than the guy before, and he's absolutely crushing it. And that's a pretty awesome situation for him to be this young and to be having this much kind of authority and responsibility and obviously comp and stuff. So that's one way to look at the situation. But with all that being said, he doesn't have to worry about raising money. He doesn't have to worry about, like he can go and say, yeah, I want to buy that $60 million deal, but he doesn't have to actually really make it happen. So yeah, those are the big differences that I see between entrepreneur and entrepreneurial. And so it's really, what you're going to see is you're going to see that going from 0 to 1 in the entrepreneur route is going to be really, really hard. It's going to be the hardest thing, one of the hardest things you'll ever do. So you'll kind of be doing a lot without having anything to show for it, and you actually won't have a lot of tangible experience. Whereas if you're at even a big company, right, you're going to see a lot of deals, you're going to see a lot of activity, there's going to be a lot going on, you'll learn a ton. And then for the smaller, kind of like in the middle example, smaller company, same thing, you're going to be able to actually do deals, and right, because the first year we were in business, we did one deal. Second year we were in business, we did one deal, right? That's not a lot of experience, that's not a lot of asset management, that's not a lot of different situations to learn from. So it's a bit of a double-edged sword. So yeah, we can talk more about that, but that's my opinion on that.
Are you currently operating a syndicated fund?
Yeah, we raise money deal by deal.
So when you're looking at your backstop investors, what are the qualities or the characteristics of those investors? Like, obviously transparency, but you don't want them ankle biting. What are you looking for in that? And it's like I don't know the current AUM, but I feel like as you grow, you kind of have to have this balancing act of giving. Maybe we'll take an ankle biter because they're going to give us more leeway.
Yes. So this is something that it's really tough, right? Because when you start, you'll take money from anyone.
Right.
And I don't necessarily think that's a bad thing. It just is what it is, right? And depending on who you are and what your goals are, you might get to a point kind of like where we are, where we're shifting the mindset and shifting our tolerance for certain things. And it's like, yeah, you know what? Maybe 10 billion or 20 billion AUM is actually not the goal. Maybe it is, right? It's just you have to figure out what the goal is and then go and match the equity to that goal and stuff. Because us getting to that size is not very practical without taking institutional capital, right? So for us, we're now kind of learning the lessons of, you know what? How do we spot the signs of someone who actually might be a headache investor? And this sounds a little petty. Even as I say it, it's like, they're actually not that big of a deal. But you also have to worry about litigation, right? And right now, 2024, this year as well, is the year of things being shaken up, of things not going well. People are having trouble, right? And when the tide goes out, you see who's swimming naked, and people are not having a good time. And this is where things get litigated. Partnerships break up, where there's merges. We're seeing it in our business a lot. We're seeing a lot of people who, it's like, we used to get investments from this small fund, and then it's like you call, and then they don't exist anymore, or they get bought and they get merged. And so there's a lot of change. So yeah, I think there's more than just like, oh, this isn't a headache investor. It's also like, well, when things go bad, how are they going to be, right? So that's something that I think you can worry about later, right? Because at first, if you go the entrepreneur route and you're trying to raise money, it's like, just take it from whoever, not worry about the terms, but then eventually start to figure out, okay, now I'm probably at the point where I'm willing to say no. Yeah.
So, just yesterday, coincidentally, we were discussing the approach to raising money, whether you go with one or two kind of anchor investors, like you mentioned, or go down the style that you're now doing, which is more retail, smaller ticket sizes. So it's interesting because I took the approach of hopefully trying to land one or two big investors, and not a lot of people said that they would prefer what you're doing, which is pretty interesting. And you've scaled quite a bit, like 700 million is not an insignificant amount. So how does that work into your kind of business plan, and how does that inform how you structure your team? Because you have 150 people, so how do you distribute that? Like, do you have more like investor relations and asset management guys, because you have so many people to deal with, so many stakeholders, and then how do you structure investments? Just like, structure it a little bit so that we get an idea of how you do that.
Yeah, so as I mentioned, we raise capital on a deal-by-deal basis. So we have to have the infrastructure and the processes in place to be able to put a deal under contract, and then in 60 days do a fundraise and get the money in the bank and close. So that is, there's no real magic in that. It's basically just, regardless of whether we're raising money for a current deal or not, we're always growing the investor base, having new introductions, having conversations, kind of onboarding them, if you will, and then keeping them warm with just, constant communication, a newsletter, a reach out, whatever. And then once we have a deal, then it's kind of a programmatic, okay, here's the deal email, and then we're going to call you, and then we're going to host a webinar, then we're going to send you the recording of the webinar, then we're going to follow up. And it's, you kind of need to be in people's faces, because to you, this is like your business, this is your life. But to them, it's like, oh, this is just like this is an email, whatever, they're busy. And so me as being kind of like an introvert and not like a natural salesperson, like to me it's like, oh, I don't want to bother them. I already sent one email. It's like, but if you talk to a true marketer, they'll be like, one email, you mean 7 in a week, right? Like that's, and so you kind of need to, in our business, you know, or in our strategy, you need to kind of take that approach a little bit of just persistence and putting it out there. As far as the team design, I don't think that it necessarily, because you either have one big investor who asks a lot of questions or a lot of investors who ask fewer questions individually, but it kind of adds up perhaps to the same amount of questions, if not less, right? Because you're going to see every style of investor. You're going to see someone who writes you the big check and then never asks a single question ever. And then you're going to have someone who's going to like think about it and talk it over, and then they'll ask you if they can invest at like the reduced minimum, and then once they finally invest, they're going to ask a question every single time, right? So you kind of have to live with both of those things, or not. Maybe you could decide, hey, I'm going to cut that off, but we kind of still go for it. So yeah, the question flow isn't so bad. I mean, basically we have Dasha as our Director of Investor Relations. So the questions kind of filter to her first and foremost. And then from there, it's up to her to figure out if she can't answer it, then she needs to go speak to the asset manager for that deal or whoever can best answer the question.
Kind of going off that, is there any point or any qualities of investors that you say no to? Like whether you approach them and then you find out like something about them, they're asking too many questions, or like vice versa, they come to you like asking to invest and you tell them no. Like what are the qualities, or I guess not qualities that
Right.
you see in those types of people?
Yeah. If they're kind of asking a lot of questions, see, it's really hard to tell because sometimes someone will ask a ton of questions on the front end, then you kind of won them over, and then they invest, and then they'll not really ask questions again. So you got to figure out like, okay, is this their process or is this who they are? And sometimes you got to make a gamble, and I kind of have trust in my team to tell me like, hey, I've been on the phone with this person and they're kind of asking the same questions over and over again, and it's like, it's just not a fit. And so then what we'll do is we'll kind of just not pursue it, and we'll kind of leave it alone. And if they really come after us, like, okay, fine, like we'll do it, but we're not going to chase them down type of thing. And this goes to kind of like an abundance setup, right? If you have built the right mousetrap, or you kind of have been doing it enough, you've built up enough investors, and you have the right kind of imbalance between available equity and interested equity, right? You always want that positive imbalance, which can be handled in 2 ways. One, generate huge interest from investors, right? So do a great job on sales and marketing. Or the other thing is, don't be so ambitious and don't go put that $100 million deal under contract, right? Because you can always throw off your balance, right? Like today, if we went and put a deal under contract, we had to go raise $50 million, we would be on the phone with people that we wouldn't want to be on the phone with, right? But if we need to go raise $20 million, we would just go call our friends, repeats, and just fill it up, and it'd be fun. So you can always manufacture the right or wrong kind of imbalance, but I would say just kind of asking a lot of questions and kind of the wrong questions that are a little off topic. Like kind of a funny thing, like the other day we had this one investor, I'm not really too involved with it, but it was just brought to my attention. And the investor's asking like, well, with Trump now, there's more deportations, and like how is this area going to be affected by that? Like whatever. It's, like, that's not our business. I'm not going to opine on that and like tell you that.
To me, the questions aren't as big of a problem. Like being in investor relations, it's my job to answer questions. I find it more offensive when people are just constantly trying to squeeze every single dollar, every single last term out. And those are the people who we more often just like won't send a deal to. Because like questions, of course, can be annoying, but at some point, like it comes with the territory, and it's our job to answer them. So I'm happy to. It's more so when people are just constantly negotiating for a better deal.
That's a good one.
I'm curious, from a macro perspective, the public perception of like interest rates has fluctuated. Initially, people were penciling 3 deals, now 3 interest rate cuts, now it's only 2. Rates are going to be like higher for longer. How do you see that affecting the capital stack? And do you feel like right now the way you finance deals will differ in the future? Or are you going to continue doing what you've been doing in the past?
Yeah, it's a good question. So the market has been really slow the last few months or so because of rates and kind of the sentiment going from, oh yeah, we're kind of getting there. Because if the 10-year treasury came down to 3.5, which it kind of just did in September before it ran up, if treasury settled around there, the market would be going crazy right now. It would be like all over again, a bubble. But we're not. We're in the mid-4s. So that's really kind of poured cold water on the market. And so, that's how that is just straight up affected us. We closed our last deal December 20, and we don't have anything in the pipeline that's under contract, right? We're looking at stuff, but it's very quiet. It has re-exacerbated the gap between buyers and sellers because it's just really pushed people into the corner of, okay, well, I'm not going to sell unless I have to. And the problem with the people that have to sell are people that own kind of the worst assets. And those worst assets, because they were financed in a different period of time where interest rates were lower, cap rates were lower, those deals aren't worth the loan amount. So they can't really sell the deal even if they wanted to, or without the lender's consent, and the lender's just going to foreclose the deal and take all this action, which takes a long time. Like someone mentioned, you mentioned like the thesis was right, but the timing was wrong. Everyone, I feel like, was wrong on the timing, right? Because in 2022, rates started going up, and everyone was like, ooh, distress time. Like, I'm going to raise the rescue fund. And then there was no distress. And there still really isn't any distress, because if you have distress fundamentals, but you stretch it out over a long period of time, the market's going to absorb that distress, no problem. It's when you have it all happen at once. Like if everyone put their deal on the market today, there would be an imbalance of sellers versus buyers. But right now there's more buyers than sellers. So even junk, even deals that should kind of be worth less, there's a scarcity premium, so they're being bid up to some extent. So that's the challenge of today's market. The other big challenge is, you're looking at the capital markets and you're looking at where SOFR is and, what the rate cuts might look like this year, and then you're looking at where treasuries are. We're in a situation now where there's basically parity between treasuries and SOFR. And so in our business, and basically all commercial real estate, if you borrow fixed rate debt, you're going to be indexed to the, commensurate treasury, right? So if you're doing 5-year debt, it's 5-year treasury, or 10-year debt, it's going to be the 10-year US treasury yield as your index, right? And then if you're floating, you're going to be floating based on SOFR. And SOFR is about 4.3% today. 10 years about it's higher. So like the 5-year, I think, is like 4.3-ish. So the reason why I say that is because basically, to make the concept super simple, you could get a fixed rate today for 6.25 for 5 years, and now you're just locked in at 6.25 for 5 years. Or you could float today, and your starting rate would be 6.25, but we'll probably get 2-3 rate cuts, and so you'll go 6.25 to 6, 5.75, and then who knows? Maybe I actually have this beautiful chart that I don't have. You can find that chart?
Yeah, the one in the shared presentation?
The one that's the presentation that's coming up, the Raise Vest presentation.
Okay.
It's not a big deal, but basically, if you look at the historical cutting cycles, it's like, here's the expectations of cuts, right? Oh, we're going to get 2 cuts this year, and it's like the dotted line, and then the actual cuts that ended up happening in these cutting cycles from 2007 and 1995 and 91 and all this stuff. It's like the expectations and then reality, right? Like most of the time, except 1995, Like of all the cutting cycles in the last 50 years, rates come down way faster than expectation, right? So maybe it's going to happen this time, or maybe it's going to be a 1995 situation where it really kind of stays. Point is, regardless, it kind of makes more sense to float today because of the potential upside, rather than just locking at 6.25 and being done. And there's more arguments as to why floating might make more sense today. The problem is everyone got burnt by floating at the wrong time in 2021. And so now they're scared to float today at the right time. So that's a psychological issue. And this kind of circles back to like another question that's been discussed, which is like investors and how does that affect the business and stuff, because who your investors are impacts what your investment strategy is, right? And you could say that that's the tail wagging the dog, but at the end of the day, they're the customer and that's their right. So the challenge is a lot of people right now reflexively want fixed rate debt because they're just like, I got burned by floating. You know, I floated when SOFR was 0, then it went to 5.5, and I don't want that to happen again. So that's a challenge. And you're seeing people who have less sophisticated investors, let's call it, they're struggling to get deals done because under the parameters of today's market, it just kind of doesn't make sense. So that's kind of a cool competitive advantage for people today who are willing to float. They can take advantage of because they can outcompete other buyers in the market who aren't willing to float. So that's my take on the situation right now.
Just building up on that question and on the previous one, how much information do you go to an investor with? Is it like a whole deal, like a paper, I know, like numbers, but do you show them if the deal has some design behind it? Do you show them the design? Because that normally triggers a lot of those questions that they're going to ask. Or you kind of like hold back on some of that information, basically what you're saying, depending on who the investor is. How do you play with that?
That's a great question. Yeah, I love that topic because you really need to know who your audience is and understand whether to give more information or give less information, and that's a really kind of good skill set, I would say, of investor relations. Because you might unnecessarily bring up more due diligence, and then they're like, oh, like what's that? Like tell me more. And then now you opened up this can of worms for yourself where they would have been just happy with like the down the fairway basics. So how do you tell? I feel like you'll know it once you see it. You know, like at this point, everyone on our investor relations team, like myself, Dasha, and Craig, we've all had definitely over 1,000. That's it. Yeah, we've had over 1,000 investor calls, right? I don't know. Yeah, it's a cool little chart to show. So yeah, once you kind of have enough calls, you kind of realize who you're talking to, you know, and it's by the lingo, it's by the questions they ask and stuff. And so I think the important thing is to remember that you're not pitching yourself the deal, you're pitching them the deal. So you need to know, like, you might have certain things that you want to know about a deal, right? But you can't assume that that's what they want. So yeah, I think it's pretty straightforward once you've done it enough and you know kind of who you're talking to. Yeah.
I think you chose Entrepreneurial at a young age, very admirable. What was a tough pill to swallow, or what was a hard lesson to learn out the gate? You mentioned raising your first fund, friends and family. You know, there's a lot of unperceived things that came up. What was one that stuck out?
So definitely a very formative experience is raising money because you're going to get rejected so much and it's going to be so hard. And it's frustrating too because it may not be what you're passionate about. Like certainly I didn't think starting real estate, it's like, oh, I'm actually going to be like doing sales and marketing. That's not what I want to do. So that's kind of like a tough pill to swallow where, you know, you might be passionate about architecture, you might be passionate about development or crunching numbers or coming up with cool deal structures and stuff, but it's like none of this works if you can't convince someone to do it, right? Or if you just have the cash somehow. So that is a tough pill to swallow, but it's kind of somewhat expected, right? And you're gonna jump into it knowing. I would say a very tough pill to swallow in my journey is that what got you to where you're at is not necessarily going to get you to where you want to go next, right? So there's phases, and specifically the tough part is when it comes to people, right? Because you can only go so far as your people, and so you might have a business partner who works out great, but then when you try to do something different or take it to the next level, it doesn't work anymore. Or you have an employee who's a great employee, but then you go from small portfolio to a big portfolio, and it no longer works out. So I think that's a tough pill to swallow because, I don't think anyone taking the entrepreneurial route thinks ahead and was like, yeah, down the road I'm gonna have to fire a lot of people, right? But you do, and so that's a tough pill to swallow. And similar, and I don't want to keep harping on the negative, like that because that is pretty negative. But another thing too, and this is a fresh wound, so it's fresh on my mind, but betrayal. These are all the facets of life. Whether personal or business, you're going to have difficult interpersonal relations, and you're going to have trust, and you're going to have betrayal. And so I think it's really smart you're going to hear this a million times. You've already heard this a million times. Trust but verify, like date, get to know someone, and things like that. But it's a tough lesson to learn without actually living through it. So that's, I think, a tough pill. And then very similar to that is market cycles, right? We've all read Howard Marks, or at least I hope you guys have read Howard Marks, and we've read about, Berkshire, just talking about the market cycles, right? Whatever market we all want to be in, whether it's real estate or anything, it's all cyclical, right? Because it's based on human psychology. And so we can read a book that talks about, or like Ray Dalio, right? Like he's in the news right now. So Ray Dalio's book's amazing about the market cycles. And we can all logically understand, okay, cool, like at the top of the market, everything's expensive, people are kind of heady, and then the market crashes, people are depressed. But until you've lived that up and down, it's really hard to actually learn. So that's another, I would say, tough pill or thing to really prepare for. And the best way, I think, to prepare for it is to actually try to live it now. Even if you're not actively investing right now, you can keep up with the news right now. And you can kind of feel what's going on. Like right now, it's just really good practice to be like kind of keeping your ear to the street right now and just hear like, are your friends getting new jobs? Are they getting promotions? Is like comp going up or is comp going down? Are people struggling to get jobs? Are people like getting great year-end bonuses? Are they selling deals for record prices? What's the media saying? So just kind of feeling the energy of the market, I think, kind of gives you a better sense of what is otherwise very difficult to learn.
You have the slide up, you want to break it down for?
Yeah, this is a really sweet chart. Credit to Pensford. I read the Pensford letter. They're a commercial real estate hedge broker. So we've purchased interest rate caps through them, and you can do swaps with them and defeasance and that kind of stuff. They read a good newsletter. But you can see the dotted lines are all the expectations of the Fed's path of rates at the time of the first cut in that cycle, right? So with every cycle, pretty much, they all started with the expectation that, higher for longer, the Fed's not going to cut, maybe a point over the next 3 years. But then look at the reality, right? Like 89 cut minus 6%, 2000 minus 5.5%, 2007 minus 5%. So the average is like 3.5%. So you can see it's a huge diversion from expectation versus what actually pans out. So like I said before, are we in a average situation or are we in a 1995 situation? Nobody knows, obviously. But that's, you've got history on your side when it comes to taking the floating rate thesis today. So that just goes back to my concept there.
I have a question on fundraising. How would you go about raising equity checks for an established firm, and how would you leverage those connections to go raise money for yourself?
Yeah, 100%. There's no reason to make anything harder than it has to be, right? So the hardest part about raising money the first time is that you don't have any experience, right? And the whole strategy associated with first-time fundraising is to try to bolster yourself with as much experience. So it's like, okay, well, maybe I haven't done X thing before, but I did it at my last firm. Or I haven't done X before, but I've done Y before, right? Like I have done single family, I just haven't done multifamily. Or I've done multifamily, but I haven't done hospitality. So trying to just aggregate as much experience as possible to bolster credibility is the name of the game. And that includes just kind of your narrative, but also more importantly, your team, right? Who you bring onto the team as your property manager or your lender, or really nice if you can find some sort of co-GP partner or anchor investor. And that way you can get the requisite kind of experience needed to help. So like for your situation, I would leverage as much as possible of your family's experience, portfolio size, relationships, reputation, like just steal it all, and make it seem better than it is. That's like no reason to make it harder than yourself, harder than it needs to be.
I'd love to talk more about that if you've got time.
Yeah, we can talk about it now, we can talk about it later, for sure. Yeah, we can circle back. Go ahead.
You also do fundraising from high net wealth individuals. It's like some funds would say that it's really hard to get institutional money these days, and they're looking into high net worth individuals funds.
Yeah. So you might have came in a little bit late because we were talking a bit about like institutional versus retail or high net worth, and we do a lot of retail capital raising or high net worth. Like I think our average check size on some deals recently is like 150. So we have like 100 investors per deal, 200 investors per deal. So we've done a really good job with that segment. And then another great segment for us is kind of like the small fund manager, or like who will invest like $1 million to $5 million checks. The $5 million and above checks, that starts to be often a very different animal, where they're looking for to be 80 to 90% of the check. They're looking for major decision rights and things like that. So you bring up a really good point, which is how hard it's been to raise institutional money over the last couple of years. And I think a big part of that is because of groupthink, right? If XYZ firm is not putting out money right now, well then, Alliance, Bernstein, or whoever, like they're not going to want to put out money either because they don't want to look like an idiot. So it's all this groupthink, and everyone's like, I'm so smart, and it's really kind of sad because we closed some deals last year that we pitched to some of our institutional partners, and there was just there was really no reason they shouldn't have done the deal, just as I'm thinking of one specific conversation, but they just couldn't do it because it's like the timing wasn't right. And it was, again, the groupthink problem. And then looking back, now it's been a year since we bought that deal, roughly speaking, like we stole that deal. Like you're not gonna be able to recreate that price. Like we bought it at a crazy cap rate, crazy price per unit. It's performing well, it's amazing. But they turned us down because groupthink. And that experience and a few others recently, really, that's when it hit me and I realized, wow, in the times when I need them, they're not there. And then when the market is hot, like it was in early 22 and 21, and these firms were putting out a bunch of term sheets and fighting over each other to put equity out, that's when you don't really need them. You can get money from anyone. So it really hit me. It's like, wow, when I need them to buy the really good deal that I could actually get rich off of because the promote's going to be crazy because that's when you buy at the bottom of the cycle and then the deal doubles, they're not there. So That, I mean, before you came, I was talking about how kind of early on we were really focused on going the institutional capital route, and then for that reason, but more other reasons, we've pivoted to really want to focus on like the $5 million check and below. That's what we want. So hopefully that answers your question. Go ahead.
You might have covered this, being too simple. So, poking around on your website, you guys seem to be a pretty firm that has a lot of young talent working for you guys. I would imagine that's presented itself as a bit of a headwind at some point for the last 7 years. Can you elaborate on how you successfully navigated that and got to $700 million?
Yes, yeah, so it goes back to your topic, which is trying to bolster credibility where it may not exist, right? Or trying to show experience where it may be lacking. So definitely one benefit is my business partner is, I think, 17 years older than me, right? So he's kind of in his mid-40s. And that's helpful. Otherwise, it's funny because it's a bit of a battle, but not as much as you think. And when I say it's a battle, it's actually a lot of times a battle here, not out there. Because when I was 21, 22, 23, 24, like scared to even jump on a Zoom call. Because like, no, let's talk on the phone. I don't want you to see my face, right? It's like it was in my head, nobody was asking me how old I am or like this and that. And if you can kind of paint a good picture of like honesty, right? But like, hey, this is my honest experience, but like I have this person on the team and we're gonna do it this way and we consulted this person. It doesn't come up as much as you think. Yeah, but we kind of brushed over this imposter syndrome idea, like how the struggle is in here. That's really real. If you are doing kind of the more entrepreneurial route that we've been discussing and my route, you're gonna feel that. And I think that's a really beautiful feeling because it really means you're pushing on the edge of your comfort zone and on like society's comfort zone as far as like what it means for you to be successful. Because kind of a lot of people and society at large kind of has their own perceptions as far as like what you're allowed to do and what your success looks like. It's like, well, you're successful, therefore you get to go work at, some XYZ prestigious company. But it's like, but no, that's not appropriate for you to like run that prestigious company or, something like that. So it's really pushing the limits. And it's not just entrepreneurial as well. There's people at our company who, because you said we have a young firm, which has pros and cons, who feel imposter syndrome as well. Like I'm sure Dasha has felt imposter syndrome. Hannah has felt imposter syndrome, I'm sure.
Yeah, all of us. Well, I started working with investors, I think, when I was 22. So I definitely was so scared, but you just have to work through it. And, no one ever comments on my age and take me seriously, so I'm lucky in that way.
Yeah, if anything, people like it. Yeah.
Since the inception of your company, what sort of returns have your investors been seeing, and then what's the program structure like?
Mm-hmm. So we bought our first deal in July of 2018, then our second deal in June of 2019. Those are two deals that we exited. The first deal was like a 3.5-year hold, and the second one was a 2.5-year hold. So average about 3-year hold. Those deals exited for a blended 30% gross IRR. So we did well with those deals. They were different business plans. Like one was kind of like roll up your sleeves, value add, like kick out the bad tenants, replace a lot of stuff, do renovations, add in washer dryers. The other one was more of like a management play where it was pretty decent shape. We just kind of enhanced curb appeal and we leased the property up from an 80% occupancy to 95. So we had a bit of a different mix of strategies, but both worked out because of the timing and the execution, right? We bought those deals in 2018 and 2019. Those were good vintages if you were able to get out, before a lot of things changed. I mean, even if you bought in 2018, well, like you could, sell today and make money. But so those are our two exits. And then now we have a 22 property portfolio that remains. And we have a couple struggling deals where there's no distributions being made, right? So we have floating rate debt. So we borrowed when money was cheap. Now money is expensive. There's no free cash flow for investors. And so that's a challenge. Like for most investors of our type, it's like there's two types of deals. Deals that are cash flowing and therefore going well, and deals that are not cash flowing and therefore not going well, right? It's kind of like they're not gonna like dig into like, okay, but like what are the KPIs and what's the reserve account look like? And they're just like, am I getting my monthly check or not? So those deals we have, I think, how many pause deals do we have? Four deals. And then the remaining are distributing somewhere between 4 to 8% annualized. So that's kind of typical for what you could expect for a company of kind of like our strategy, our size, and our vintage, meaning like the years in which we bought. Because it's really just brass tacks. Like, I don't have to know anything about a deal or the asset class. The reality is, if you just tell me the date that the deal was purchased, I can more so tell you how that deal's going or how it went. That's just unfortunately the reality of an interest rate sensitive business that's cyclical like this. So yeah, that's just kind of like a other red pill or just kind of a reality. It's like, you get the timing right, you're probably gonna do pretty well. Or you expand and you grow too quickly at the wrong time, which we have some friends or competitors who have done that, and it's like, there's a lot of challenges right now, and that's where the distress is. So, but anyway, we target about a 15% net IRR to investors. In order to hit that, we need to have about a gross IRR of around 20 to 23. Because our promote structure, and we're actually rolling this out brand new. So I can share this because I think it's pretty interesting topic because it's like our pricing model for the business, right? And it's strategic. So we just actually changed our waterfall structure for our minimum investors, or kind of like our base investors, if you will, with a 50K minimum check. That's like your entry level tier. We brought the pref down from 8% to 7%. So now basically all the distributions from the deal first go towards serving that 7% pref. That's cumulative and compounding. And then any proceeds thereafter go towards paying them back, right? And so then once they've gotten their 7% IRR, now we have the waterfall split, 70-30, and that takes us up to a 15% IRR after the investors have made a 15, if they've made a 15, because obviously not every deal is going to perform to that level. Then the proceeds thereafter are 50-50. So that's kind of like our home run hurdle, right? And you're not really ever going to get that from an institutional partner, a 50-50 over anything, pretty much, right? Like out of principle, they'd be like, well, give me a 50-50 over 25. It's like, no. So for institutional waterfalls, which I feel like you guys are probably more familiar with just based on case studies or being in the market, a more institutional waterfall is like a 10 pref, and then with a 80-20 split or 20% promote. And then after you hit like a 14, 15, 16, then you might see like a 30% promote or a 40% promote. So that's our base. So it's kind of like our worst terms, right? And then we have the next tier up, which goes from a 50K minimum investment to 500K. And now, can you correct me if I'm wrong? Because I know we just changed this. So for Class B investors, 500K minimum, it's an 8 pref, or is it a 9 pref now?
No, it's an 8 pref.
Okay.
And then Class C is 9 pref.
Right. Okay, so the step up is now, okay, you go from a 7 pref to an 8 pref, and then it's a 70-30 split. Right, so you get a little bit better pref, and then you remove the home run hurdle over 15. That's for 500K. And then for $1 million, it's a 9 pref with a 20% promote. So you kind of basically like at $1 million, you pretty much have an institutional, level waterfall with us, which I think is pretty friendly. But the reason why we're willing to do that is because we charge higher fees than what an institutional partner would be willing to pay us, right? That's where that's a big difference between doing institutional deals and raising retail capital is the fees are going to be very different. Like we charge a 2% acquisition fee. You're going to arm wrestle with an institutional partner over like a 75 basis point to 1.5% AC fee, depending on the deal size and how good the deal is.
Say the IRR is 15%, as a C-class investor. Is that investor earnings?
Yeah, see you later. If you guys want either of my books, go ahead and grab. And then also we host we host these events where we smoke cigars and stuff, and so there's torch lighters if anyone wants one. Yeah, the torches are sweet.
I guess the simple part of the question is the investor earning, if the investment's 50 grand, do they earn your 15% on 50, or is it 10 grand on 1, 15% on 10, 15 grand on 2, 15 on 15, 20? You know, there's some syndicated funds that will phase out that 50 grand, so you're never really earning 15 on 50. You're earning more so it's phased out.
No, so yeah, it doesn't work like that.
Okay, this is all in.
This is all in. I'm not exactly familiar with what you're talking about. Maybe that's more of like a development thing where they're drawing the funds, right? So you're not actually earning your or accruing your pref, except on drawn funds. But we basically, we get fully funded at closing or before closing, and so they start accruing their pref the day they fund. And so that's actually a cool change that we made like last year or the year before, is that a lot of companies similar to us, you fund and then the pref starts accruing at closing. We changed it so that their pref starts accruing when they fund. Because it's like, why wouldn't we want to incentivize people to fund sooner and start? Because otherwise people are going to hang on to their money until the last minute and then fund the day we close. That's a headache for us. So we'd rather pay them more in accrued pref to get their funds in earlier. So that's just like a little business tweak. That's a nice tweak, but yeah, it's very standard waterfall, super easy to model. In Excel, I'm sure you guys have all done it.
I have one question, and it kind of goes on what we're talking about right now. Like in the last year and a half, 2 years, everybody's business plans have had to shift. So there's some deals that maybe you're not looking at a promote no more, and in the book you talk about promote crystallization, where like your ownership interest shifts, right? Can you kind of like explain like how that system works when you make that decision, like, hey, we're not gonna hit a promote here, so now it's gonna be time to shift over to a cash flowing model, and how the negotiations go on with investors in that time period?
Yeah, so there's a couple bigger topics perhaps in that question. One is promote crystallization, which is a fun topic to think about, but in practice it's not that common, but still we'll definitely go over it. And then the other topic is, what happens to a deal where the promote looks unlikely to be worth anything, right? Because that's a problem for everyone involved. It's a problem for the sponsor because it's like, oh, bummer, I thought we were going to make a promote, now it doesn't look like it. And then it's a bummer for the LPs because now they're worrying about a manager who may not be really incentivized. It's like, because again, forget reputation and like trying to run a good business. A promote is basically a call option, right? Like heads I win, tails you lose. Either way, I don't lose, right? I didn't put any money. Let's say I didn't put any money in the deal, so all I have is this promote. The deal goes well, I make money. Deal doesn't go well. Sorry, LPs. So LPs need to be wary of that, right? They don't want the sponsor's call option to be worthless and then the sponsor to have no interest in managing the deal. So that's a separate issue. And you're seeing situations where when that happens, the equity in kind of like a more institutional scenario perhaps kick out the sponsor, depending on what the control rights are, and replace the manager and stuff like that. Or the sponsor will just kind of want to walk away. It's like, well, why am I asset managing this deal and stuff? It's taking up my bandwidth. Because unfortunately, the deals that are the least profitable take up the most time, right? So that's just an issue, right? And I think the positive way to think about it is if you're a long-term minded sponsor, you're going to want to do right by your investors, and you're going to want to preserve your reputation above and beyond a promote that may be worthless, right? So you want to look at the big picture. So we've got deals that, like we have a deal that is on floating rate debt. So it's one of those deals that are not distributing. And we have one big LP. We have a 90% equity partner in the deal. And that's a tough scenario. It's like, sorry, we did a joint venture. There's no distributions. We bought at the wrong time. We used floating rate debt we should have fixed. Like, we made these mistakes. And instead of us being like, well, screw this, whatever, like we're not charging property management or asset management fees to the deal. So we're, you could say operating the deal at a loss because we still have costs associated with operating it. But it's like, who cares if we're not making that, 150 grand a year or whatever it is in fees, because the relationship's more valuable, right? So I think that's the right way to look at it. But everyone's got their own business to run and everyone's got bills to pay. But anyway, so that's one problem. The promote crystallization thing is not something you would use when you don't have a promote. It's actually something you'd use when you do have a promote that's worth something. And so a promote crystallization is a way to, as a sponsor, monetize your promote, basically put money in your pocket or recognize the promote without actually selling. And this is a big problem with the private equity model, which I'm sure you guys all have felt or seen, which is that there's the incentive to sell, right? It's like you buy the deal, you buy the company, and you try to fix it up quickly and then sell, and that way you can make the money and then you're off, right? And there's pros and cons to that. I mean, yes, you can maybe get a good IRR, whatever, but then you're churning and burning. It's always like up and down, up and down. And if you look at at least the richest individuals in the world, and just the way that wealthy people think about money and invest is they buy and they don't sell, right? Their hold periods aren't 3 years, they're 30 years. So that's wonderful. Like, we should all learn from the wealthiest people and try to maybe not necessarily copy that for every deal, but maybe there's a place for that, right? But there's not really a place for it in private equity, because if you knock a deal out of the park, like let's say your development deal, let's say you had an LP on it and you had a promote interest, right? And you guys build the deal in 2 years, and now if you sold it, your promote is worth $1 million, right? That's exciting. And if you sold the deal, you'd get $1 million cash in your pocket. But what if it's a really good asset? You just built it, so it's brand new, it's cash flowing, it's not a headache to run. Oh, and also if you don't sell, there's not gonna be a tax consequence, right? Well, if you don't sell, then that $1 million is just on paper. You can't spend it, you can't whatever, it's stuck. And the problem with the waterfall structure is we all know that IRRs decay with time, right? So if I get in and out and do a value add and sell the deal in 2 years, my IRR might be 25. But if I do everything the same, but then end up just holding the deal for the full 5 years, that IRR might be 15. So at 25% IRR, I would have been in my home run hurdle and got 50% of the cash above and beyond a 15% IRR, right? But if I hold for 5 years, then I get no proceeds above 15, right? Because I'm only getting a 15. So that's the struggle between wanting to hold long-term versus wanting to make your promote. And that's where promote crystallization can come in, where you can actually have a partnership mechanism where it's baked into the docs. You go to your partner, like on your development deal, let's just say, like I'm your equity partner or something, right? You come to me and you say, okay, we built the deal, we leased it up, it's a success. I got an appraisal, the deal's now worth $10 million. And I go, oh wow, that's a great appraisal. And I actually believe in that appraisal. Like, okay, I legitimately agree that that's this deal's now worth $10 million. Now, instead of selling it for $10 million, we could just plug in a $10 million sale through the waterfall, and we could see what your promote would be worth. And let's say that your promote's worth $1 million, right? Like we said. And then me as the LP, we can adjust our ownership percentages. So I basically reduce my ownership percentage, and yours increases by $1 million at that valuation. And now we've crystallized the promote. The pref goes away, the promote goes away, and now we own the deal pro rata, and we just split the cash flows pro rata, and we go about our business. You have no itch to sell, because it's like, well, now you have this $1 million equity position and you're getting cash flow on it. And I'm not itching to sell because I'm riding shoulder to shoulder. And the benefit as well is me and you are aligned, right? Like if both of us are enjoying the cash flow, then we're probably both enjoying it. If one of us wants to sell, we might both want to sell. So it stops this problem. The promote crystallization stops the problem or stops the clock on this feel of this urge, like I need to sell and make my promote. So you see it most commonly on development deals because development deals have a J curve of value creation, right? It goes from land to a cash flowing stabilized asset to create all the value. And then now you have a core asset, and rather than selling the asset, you just hold it. But a developer isn't typically in the business of, holding core real estate. They're in the business of building, and then they want to go on to the next. So it takes a unique mindset and a unique partnership to be able to say, hey, we're going to build this together, crystallize the promote, and now we're going to be just basically pari passu partners thereafter. I would say that if you can pull this off with the right kind of investor, it could be super in your favor. See you later. Right? With the wrong investor who's like more savvy than you and is bigger than you and stuff, they could probably bully you, and the terms of the crystallization are not good. Right? So it's like a good thing or a bad thing just depending on the terms.
So building on that, how would you advise us to structure a promote crystallization into our deal? And is there something specific that we should be looking for? Where should we be putting this out there when we're negotiating that agreement? Is it in the partnership agreement, or is it with our attorney having our counsel know in advance that we want to kind of get this done?
So it would be in your JV docs, whatever that looks like. It could be in your LP agreement or your operating agreement for the LLC. It's very simple, right? You as the sponsor are going to want the promote crystallization to be based on as high a value as possible. And the LP is going to want the crystallization to be valued at the lowest value possible, right? So the methodology of valuation is critical, right? Is it going to be based on a random appraisal by your friend? Because that's good terms, right? Or is it going to be, an appraisal ordered by the LP, and like the LP has full control and say and influence over this appraisal and stuff, right? Because that's not good. And so, yeah, you want to meet in the middle somewhere. It's like, hey, you get an appraisal, I get an appraisal, and then we have like whatever. Like it just needs to be some way that you come to an agreement. I don't have experience with it, so I don't know what would be the slickest way to do it. Yeah, see you later.
Building off that, you mentioned that this promote crystallization is most common in development deals. Would you take it a step further to say that in a particular asset class, maybe for example, luxury condo or luxury rentals, that this would be more prevalent versus another asset class?
Yeah, for sure. So like I said, it's going to be most prevalent on development, and then it's going to be most prevalent on perhaps like luxury or core development, right? If you've got like a merchant builder who's doing, stick multi-construction in the suburbs, it's like whatever. That's not a trophy asset. Like they can just build it, sell it, and then buy the next piece of land out in the suburbs and just keep going and going, right? But if you're talking like, hey, we've got trophy land, we're going to build a trophy property, this is not something that anyone should ever sell, okay, then that's crystallization is your only route.